studying your last two. I swim with tea when they turned in. The staring down to mute and can lend a pole that sunky died.
Every capital asset owned by a corporation does not receive the same capital cost allowance deduction. Instead, the Canadian tax system groups similar assets into different capital cost allowance, or CCA, classes, and each class has its own prescribed CCA rate. Think of a CCA class as a category. Assets that have similar characteristics and similar useful lives are placed into the same category so they can be depreciated using the same tax rules. For example, a computer, office furniture, a delivery truck, manufacturing equipment, and a building are all capital assets, but they do not lose value in the same way or over the same period of time. Because of these differences, each asset belongs to its own CCA class and may have a different CCA rate. The important point is not to memorize every class or every rate. Instead, understand the overall process used by professional tax preparers. When a corporation purchases a capital asset, the first step is to identify exactly what the asset is. Is it computer equipment, office furniture, a vehicle, manufacturing machinery, or perhaps a building? Once the asset type has been identified, the tax preparer determines the correct CCA class. After the correct class has been selected, the prescribed CCA rate for that class is applied when calculating capital cost allowance. Finally, the calculation is recorded on Schedule 8 as part of the corporation's T2 income tax return. Notice that the process always follows the same sequence. Purchase the asset. Identify the asset type. Determine the correct CCA class. Apply the prescribed CCA rate. Complete Schedule 8. One helpful way to think about CCA classes is to imagine a filing cabinet. Each drawer represents a different CCA class. Whenever a corporation purchases a new capital asset, the tax preparer first decides which drawer or CCA class the asset belongs in. Once the correct drawer has been selected, the corresponding CCA rate is automatically known because every class has its own prescribed rate. This is why choosing the correct CCA class is so important. If the asset is placed into the wrong class, the wrong CCA rate may be applied, resulting in an incorrect capital cost allowance calculation. Throughout the next lessons, you'll become familiar with many of the CCA classes commonly encountered when preparing corporate tax returns. The goal is not simply to memorize class numbers. The goal is to develop the habit of correctly identifying the asset first, and then determining the appropriate CCA class before beginning any calculation. The key lesson from this slide is simple. Every capital asset belongs to a specific capital cost allowance class, and every CCA class has its own prescribed CCA rate. Professional tax preparers always identify the asset type first, determine the correct CCA class second, apply the appropriate CCA rate third, and only then calculate capital cost allowance on Schedule 8. When a corporation purchases a capital asset, one of the most important decisions a tax preparer makes is selecting the correct capital cost allowance, or CCA, class. This decision is never based on guesswork. Instead, professional tax preparers follow a consistent review process to ensure that every asset is classified correctly before calculating capital cost allowance. The process begins with the purchase of the asset. Once the asset has been acquired, the tax preparer carefully reviews the asset description. This information usually comes from the purchase invoice, product specifications, manufacturer documentation, or other supporting records. The goal is to understand exactly what the corporation has purchased. Next, consider how the asset will be used in the business. The business use of the asset often helps determine which CCA class is appropriate. For example, a computer, a delivery vehicle, office furniture, manufacturing machinery, and a building are all capital assets, but they serve different business purposes and belong to different CCA classes. After understanding the asset and its business use, compare its characteristics with the available CCA class descriptions. This comparison helps identify the correct class based on the asset's nature and intended use. Once the appropriate CCA class has been identified, the corresponding CCA rate is applied. Because every CCA class has its own prescribed rate, selecting the correct class automatically leads to the correct capital cost allowance calculation. Finally, the completed calculation is recorded on Schedule A. Throughout this process, professional tax preparers ask themselves several important questions. What type of asset is this? How is it used within the business? Which CCA class best matches the asset? What CCA rate applies to that class? And have I documented the reasoning behind my classification? Answering these questions before performing the calculation greatly reduces the likelihood of errors. One of the most common beginner mistakes is guessing the CCA class without reviewing the supporting documentation. If the wrong class is selected, the wrong CCA rate may also be used, resulting in an incorrect capital cost allowance calculation and potentially affecting future tax returns as well. That's why experienced tax preparers rely on documentation rather than assumptions. They review purchase invoices, product information, asset descriptions, and other supporting records before assigning a CC class. The key lesson from this slide is simple. Professional tax preparers identify the correct CC class by carefully reviewing the asset's description, understanding how it will be used in the business, comparing it with the appropriate CC class descriptions, and documenting their decision before applying the prescribed CCA rate on Schedule A. By following this structured decision-making process every time, you'll prepare more accurate capital cost allowance calculations and avoid one of the most common sources of error in corporate tax preparation. Before calculating capital cost allowance, professional tax preparers perform one final review to ensure that every asset has been classified correctly. This review is one of the most important steps in preparing an accurate Schedule A, because selecting the wrong CC class can affect not only the current year's deduction, but also future capital cost allowance calculations. The review begins by identifying the asset. Ask yourself a simple question. What type of capital asset is this? Understanding exactly what the corporation purchased is the foundation of the entire classification process. Next, review the supporting documents. These may include the purchase invoice, product specifications, manufacturer information, the fixed asset register, and any other records that describe the asset. These documents help confirm the nature of the asset and reduce the risk of assigning the wrong CCA class. After reviewing the documentation, determine the correct capital cost allowance, or CCA, class. Once the correct class has been identified, apply the prescribed CCA rate for that class and calculate the allowable capital cost allowance. The completed calculation is then entered on Schedule A, and the corporation's asset records are updated to reflect the current year's activity. Throughout this review, experienced tax preparers ask themselves several important questions. Is this truly a capital asset? What type of asset is it? How will it be used in the business? Have I selected the correct CCA class? Am I applying the correct CCA rate? Have I reviewed all supporting documentation? Have I documented the reason for my classification decision? Is the capital cost allowance calculation accurate? And has Schedule 8 been completed correctly? Answering each of these questions helps ensure that the classification is supported and the calculation is reliable. To complete this review, tax preparers typically rely on several key documents. These include the purchase invoice, the fixed asset register, Schedule 8, financial statements, the general ledger, product information, calculators, and supporting working papers. Each document provides information that helps verify the correct classification and supports the corporation's tax records. One of the most common beginner mistakes is assigning a CCA class based on assumptions rather than evidence. Guessing the class without reviewing the asset description or supporting documentation can result in the wrong CCA rate being applied. This may lead to incorrect capital cost allowance calculations, inaccurate undepreciated capital cost balances, future tax reporting errors, and potentially costly reassessments. The good news is that these mistakes are usually preventable. By following the same disciplined review process every time, professional tax preparers consistently produce accurate results. The most important rule to remember is this: never begin calculating capital cost allowance until you have identified the correct asset type, assigned the proper CCA class, confirmed the applicable CCA rate, reviewed the supporting documentation, documented your classification decision, and verified that Schedule 8 is complete. Following this professional review checklist will help you avoid classification errors, prepare more accurate corporate tax returns, maintain reliable asset records, and build the confidence needed to complete Schedule 8 correctly every time.